Welcome, guys. Welcome to this session on Investor Week 2023. This session is mainly about busting the myths about investing and introducing everyone and giving everybody a reality check. Today, we have with us Mr. Saurav Sultania. He's the Vice President at ICICI Securities from the Equity Product Group. Abhishek Murarka, he's the lead social media for ICICI Securities and a very active voice on Twitter and probably a Twitter celebrity. So, welcome, Saurav. Welcome, Abhishek, for this session.
Hi everyone. Good afternoon. Thank you, Gaurav, for the introduction.
Yeah.
Thanks, bro.
Abhishek will be taking us. Saurabh would be taking us through in the first half, and after he finishes, Abhishek will be taking a generic view on equity investing. So, Saurabh, we can go first with you. I'm sharing the screen. Let us and going on.
So, thank you. First of all, it's nice being here, and I'm just going to run you through basic concepts and basic trends on stock markets. And we can kind of just move through the slides and we'll see. So let's just go to the slides. And before we start, and how we're going to talk about the presentation is that and I'm going to take you 10 years back, 20 years back of how investing has been in India, and what trends did we see. Gaurav, you just want to move ahead. Yeah, I think at the time. Okay, so this actually, if you ask me, yes, thanks. This, in fact, if you ask me, is a very visible slide, and I'll just kind of stay on this slide for some time. Today, if you see the interest which is there in stock markets of retail investors is significantly high. This bar shows that 2.6 crores Indians actually traded in the stock markets over the last 12 months, and this is FY 22-23. And this is a sizable number. And now, if you just go back 10 years back, 43 lakh Indians used to invest in stock markets. This is a telling story, from two perspectives. One, today when you go to small towns, you go to a Shimla, you go to Solan. I'm saying not small town, but towns also. There is so much youngsters, interest in stock markets. People want to invest. But if you just cut back 15 years back, cut back 20 years back, there was this fear. Stock market was always something, which Indian societies, Indian families used to have a fearful approach that, it's a high risk, don't invest, and this numbers speak for itself, right? I mean, we're talking about 43 lakh people in FY14. If you talk about 2004, 2000, this number will be 10 lakh, 15 lakh investors in India. Now, there are two things. If I just put you back to, let's say, US market, which is a very, very far developed economy, in US, around 55% adult Americans invest in stock markets. In India, I mean, 55%. Robinhood is one of the largest platforms in US. 2 crore Americans log into stock markets every month in US. Every month. And, so what I'm trying to say is that, what we see, is a little more episodic shift in investors investing in stock markets. Today, you talk to kids, they don't fear stock markets. Indian families don't stop their kids from investing in stock market. They say, invest wisely, अच्छे stocks में करो, but करो. This is, as I mentioned, is an episodic shift in the Indian, in the behavior of society. And, those, in our opinion, is a little more long-term shift, which happens. And that's one of the things which, is a very favorable scenario for investing in equities. So this is one backdrop that we are in. It has multiple ramifications in terms of the kind of money flows which happens, the kind of SIPs flows which happen, and domestic savings which get channelized to stock markets and to equity as an asset class, and which which reduces our dependency from FIIs investments. And it's not like 10 years back, the FIIs sold stocks and Indian markets falls 3%. So there is domestic liquidity, and they're at the tip of the iceberg. I mean, they're still not. This number is even if you look at population which has a high income surplus, this is there is a tremendous scope. And as I was referring to, you look at developed markets like US, Europe. I mean, there is a sizable population in Indians investing in stock markets. So this being the background, and just want to add that, you look at go to kids in colleges and all that. Really, I would feel. I mean, these are rough numbers, and these are personal, experiences that nearly 40-45% of the kids are investing and have interest towards investing. So we are in exciting times, and and some of the trends that we want to share. Gaurav, just would you like to just move ahead? Yeah. Okay. So and we are talking this concept. This session today is a very basic session. This session is about what are the fears which investors have. What actually investing in equities mean. For people who are new to investing. Why do stock prices go up? What are the reasons why stock markets don't do well? I mean, we're just going to talk very laymanish. We're going to talk basics. We are not going to get into high, technical stuff here. And essentially, when we are as an investor, what are we? We are investing in companies, right? And if the company is going to do well, if I'm an owner, I mean, investing in equity basically means taking a ownership in a stock. That's it. I mean, obviously, we're not 100% owners because we don't have 100% equity. We are part owners, fractional owners to the fraction of stocks that we have. But essentially, it means that if that company will do well, our investments will do well. Generally, that's the long-term experience that we have, right? So, I mean, if you are investing in a stock, you are investing in, I mean, any of these stocks, you're just taking for reference, you're actually investing in the growth of the stock. The company is the one who's going to work, create wealth for you, and shareholders create the value, see the value. So, I'm saying we will move ahead, we'll see more slides on how these things render. I mean, again, these are numbers that we have seen, and these are things that we've seen in our lifetimes. Not even that we are talking about 1990s stuff. You look at the kind of wealth creation which has happened in stock market. I mean, Nifty around 2007, 2008, 2009 would have been at 2000 levels or even lower 2000 levels. Today, Nifty would be at what, nearly 20,000 levels. I mean, you look at stocks, I mean, any large cap stock, if people have invested in good companies in India, you look at banks, you look at tech companies, you look at manufacturing, you look at, if you have invested in good companies, the kind of wealth creation, and this is just stock prices. I mean, the dividend income itself has been 1.5% dividend, which has come every year to investors. So it is a true, CAGR returns in stock market in 15 years, 15%, sorry. So this is a true area where investors have created wealth. But obviously, it is not for 3 months, it is not for 6 months, it is for 10 years, it is for 15 years. If you are sitting, if you invest in good companies and invest that kind of cash surplus, which you don't have to worry about for the next 3-6 months. Long-term equity market, and it's not about markets, it's about the companies. It is these companies, an ITC, you're seeing a Maruti, and if the company is going to do well, if the sector is going to do well, investors will have wealth creation. And that's what has happened in Indian markets, and developing economies, in the phase of going to develop, the value creation is always significant. So let's just move ahead, Gaurav. So this is something, is a single line, but this is what exactly holds investors from investing in participating in the stock market. That the fear that one day will go down, something will happen. So you look at, I'm saying you can look at anything, let's say an oil crisis or inflation, you look at war, and markets have seen everything. I mean, not now, from last 50 years, you look at Gulf War, you look at inflation, you look at recession. Stock markets or global markets have seen everything. But today, after seeing all that, we are at the peak, we're sitting at 20,000 levels on Nifty, around 65,000 levels of Sensex, and as we said, India is a very young economy. India is growing far, among the largest growing economies in the world. and it's only when, as I said, when economies move from developing to developed status, the growth in per capita, the growth, in the income, disposable income of, the Indians or that society is significantly higher. So, but, this is what just holds investors, and we kind of see ahead as to what kind of moves stock prices. So, Gaurav, just let's move ahead. So this, I just want to kind of give you a macro feeling, macro perspective. Again, this presentation is to understand the basic tenets of investing. Why should you not fear? Why should you? What should you think about? And and India, and why are we different, right? And this is one thing about investing is the social fabric, and which happens in financial markets. Is the economy going to grow, or the economy will get bogged down by social unrest? I mean, this is a flag which you see on the left hand side. We don't World Cup. This was in Brazil. So I'm saying whenever societies will go through social unrest, there is a development, there is a growth which will kind of stagnate in that society. And we've seen that examples across the globe. You can look at it. You can see what's happening in Middle East right now. These societies will take years to get over this kind of the crisis and then get into growth phase. Luckily, as we speak today in India, that's not the stress that we have. And I'm saying, whichever cities in India or states in India kind of face this, I mean, you look at, let's say, at point of time, West Bengal used to be such a kind of dominant state in terms of education, because of, let's say, local issues on bonds, the society or the development in the state kind of stopped. So I'm saying if India today is unlike, you look at anything, you look at Sri Lanka, you look at any economies, India is far more, India does not have these kind of issues. So that's a structural positive that we have as a society. Just move ahead. Okay, so now this is, I'll just take it in very simple, in very, very simple terms. Why do stock prices move up? One is the structural society has to be, so the tenants have to be good. And just to give you a perspective, another perspective, India today, we would have amongst the largest young population, which is getting the job markets. In fact, till 2035, the Indian population, we will be, the population will only grow, the young population will only grow. It is only after 2035, wherein India will start witnessing a diminishing population effect. And you look at, economies like Japan, you look at, economies like China, you look at young, old population, you understand how, that the disposable income is lesser. And once the disposable income is lesser, the value creation chain which happens in society it diminishes. So I'm saying obviously those economies have done very well, but I'm just telling you that how today we are structurally different. We have a structural advantage, and which has obviously for the last 20 years played out, and the next 20 years can see far rapid growth. But having said it, I mean, we are neither a one sector, oil sector dependent economy. We are a multifaceted economy with high growth rates. But coming to stocks, the stock prices only goes up if the earnings of the companies go up. I mean, that's it. I mean, it's like a business. If I am my business earning 10,000 rupees, and if I today make, 1 lakh rupee of profit, if I make, a crore of profit, my valuation will go up. I mean, simply in simple terms, that's how over the long term it plays. In the short term, there are various phenomena. We will kind of see as we move ahead. Gaurav?
Yeah, Saurav. Hi. So,
Yeah.
hi, Abhishek Murarka here. So, I just wanted to add few thoughts on this slide only because I had something very similar to present. And although I have it in a separate set of slides, but when Saurav is saying why do stock prices move up, one factor is earning, one is valuation. I see it as a ratio. What is your return? What is your return? Return is nothing but future price divided by current price. That is your return. What is future price? Future price is future earnings into the, say if you're looking at price to earning ratio, then it is future earning into what P multiple the market wants to give to that earning. That is your future price of the stock, and the current price is your current valuation is your current price into the current multiple. So in this scenario, I think it will be easier if I can just share my slides, or it will be much like easier on this point. I just wanted to have some thoughts.
Yes, yes.
Just a minute, I'm sharing my slides. Let me know when the screen is visible.
It is. Yeah.
Perfect. So now just elaborating on what I was saying. Now, there are two ways to make money in the market. Either the company in which you are interested, its financial metric on which like an investor is giving valuation, either that goes up. But even if that is not growing up, the second thing is market is willing to give more higher multiple to that price. So just look at this ratio. What is your return? Your return is future price by purchase price. And what is your future price? It is your the company's future earnings into the future PE multiple. That is your future price, and your current purchase price is your current earnings into the current PE multiple that the market is giving. So for you to get return, either your future earnings have to grow significantly or the multiple has to go up. So let us look at each of these two metrics. Now, if a company is say earning, there are various ratios in which people can see it can be price to earning. For some capital heavy industry, it can be EV EBITDA. But in any of these, the operating or the financial metric for it to grow, you have to think what is happening, how is it growing. One can be, say, if I'm looking at it as linear model or expansionary model. लिनियर मींस अगर आपकी इंडस्ट्री में ही बहुत ग्रोथ, अगर इंडस्ट्री में अगर आउटलुक लग रहा है कि 20 से 30-40% ग्रो करेगी, फॉर एग्जांपल लुक एट इलेक्ट्रॉनिक्स इंडस्ट्री, लुक एट say if semiconductor industry picks up, or look at in a good cycle microfinance industries, these spaces give very good industry level growth, 20%, 30%. अगर industry is growing, and if you're picking the relatively better company in that industry cohort, chances are that your revenue and your earnings are anyways growing. Second way is, okay, industry is growing, but my company is growing faster than the industry, so I'm getting market share gain. Third can be margin improvement. If like in the entire supply chain of how my say raw material comes or how my service is delivered, if that becomes either more cost efficient or you are able to charge more prices for your end products, in either the two cases your margin expands. So these are the I would call linear models, and then there are expansionary model. If a company goes has a lot of cash sitting on the balance sheet, it can go and acquire new products, or it can do acquisition new geographies or launch new categories. Any of these ultimately lead to expansion in your numerator, which I had in the previous slide, which I'm talking your future earning uh, compared to the current earning. The next one is your other lever could be if your valuation goes up, market wants to give you a higher valuation. So that happens in two ways. One is, say, if there's a change in perception of the company or change in perception of the management. So, and this is a great way if you can identify change in operating metrics early and have a confidence that market will value this higher, you get the double benefit. One is your earning expands, and then the second benefit you get is of a re-rating. When you get both the combination of earning expansion and re-rating, you tend to have I would say outsized returns. So like multiple expansion can happen through a change in perception, or it can happen in change in reality. Change in perception generally applies to say cyclical industries, or may apply to many companies which have some issues in the past, but say the management has now changed. If the management has changed, company had issues in the past, that perception can change based on consistent delivery. And change in reality is when, for example, your the capital ratios or maybe the outlook of the growth, those expand. So these were the few thoughts I wanted to share. And last slide, I only had one more slide. There are three pillars to investing. One is the company's core business should have attractive economics. It should have a long runway for growth. If a company, if many things, many kind of stocks will find which have very high return, high growth in the last 1-2 years, but still don't get a good multiple, because then there is no guide, no clarity on the sustenance of growth. And the last and most important is capable and trustworthy management. If you get a combination of these three, you will have generally have a great combination, I would say, an investment stocks. So I will pause here and ask Saurav to take charge again, because I want to expand on that earning and valuation part.
Right. No, thank you, Abhishek. In fact, I will actually, if you ask me, the next slides are just telling, building on what you've actually said. So, Gaurav, if you just move ahead, I mean, just showcasing in very simple terms for investors who are new to investing, I mean, and these are two screens just to show you what Abhishek was trying to say, that where, I mean, where growth has come, and growth is in terms of reality, in terms of the attractive segments, pricing. I mean, everything is what you see in these two screens. 50 years back or 40 years back, India used to be on bicycles, and today, I mean, you look at where we are, and if you now think about the future, future is going to be very different, right? I mean, it is about that ability of predicting the future. I mean, if today, by 2030 or 2035, people are talking about EV, you can then think about what Abhishek was saying as the opportunities, right? And, when this transition happens over the 20 years, 30 years, this is where true wealth creation happens. For all sectors which you identify as transformative sectors, and we can kind of talk about, let's say, two, three more examples, and then, we could kind of think about sectors which from today over the next 20 years and 30 years will be very different, right? Gaurav, if you just move ahead, uh, this is what banking used to be in India, right? I mean, you look at, and I mean, some of you would have seen it at least physically, or your parents, or people have seen this. This is what 30 years what banking used to be, and you look at banking today, completely digital. Look at the way lending happens today in societies versus how lending used to be, done 20, 30 years, 40 years back. And again, it's just what I would just like to reiterate what Abhishek was saying is just getting that opportunity, just spotting where that big trend. And these are very simple things. These are not rocket science. These are things which are there in front of our eyes. There is nothing that in investing is not complex. At least these are all simple trends. If I mean, we can just go through Gaurav, just move ahead one slide and then ponder over some of the long trends that you can think about yours in the society itself. This is like what telecom has been, right? Just I mean, I mean, you can be in that telecom booth, and many of you would have been in the telecom booth, and where telecom is today. And it's just about identifying the opportunities, and maybe does the opportunity exist in which stocks, which sectors do those opportunities exist? I mean, technology obviously has been, and the way technology is changing. You look at defense. Defense is a sector. I mean, you look at some of the F-16 and the kind of jets which US has, China has. You look at the kind of geopolitical tensions which have happened in front of our eyes. It's only societies and economies which have strong defense, capable defense, can actually will be one of the pillars. Look at EV. I mean, I'm saying think about sectors, and Abhishek, you may like to, if you want to add something, you can add. I'm saying, just identify the trend, and then the wealth creation truly happens.
Yeah, Saurav, I'll add a thought to this. So technically, there's a term called value migration, and this has become like commonly used in the recent past. But if you are somebody who has like a keen eye to identify where are trends changing, and if you are like if you have the confidence to be early on it in just backing the right player in that, investing can actually be easy, and it's a great time to be somebody who's very acute sense of observation. If you see so much is happening around us, I'm just thinking of some like smaller examples. If you see, for example, let's think of office. In office, I'm sitting, there's a glass bottle in front of me, which used to be a plastic bottle. If I just see which is the maker, it's a company called Borosil. I'm not showing. By the way, it's not a recommendation to go and buy Borosil, but because of this, say, entire focus towards environmental pollution, recycling, there has been a shift from plastic bottles into glass bottle. Who makes it? You Google it and you find a company called Borosil makes it. I'll give you another examples. People are upgrading into modular kitchens. Like if you talk to your wife, like currently say, I know this because one requirement will come, well, kitchen should be modular. that is will hear always from your wife. If a kitchen is modular, you just understand what is the difference between a modular kitchen and the old school kitchen. You will go and see the one difference will be in the kind of crockery that is used. Second, you is in the kitchen sink. Now people are using, like, even mid-premium houses are using quartz sink. So there's a company called Acrisil, which if you see the share price, it has gone up 5x. And this trend has been started playing out in the last 5 years in front of our eyes. There are so many more interesting micro trends which we'll observe and probably just needs a keen sense of observation.
Yeah, I mean, in fact, now that you're telling me, I'm saying even not even very micro hospitals. I mean, what used to happen 20 years back or 10 years back, if a child would have a cut in the hand, people would just put a band-aid and Dettol and that's it. Today, if our child, if child gets a cut, you go to a doctor, you see, I'm just trying to say very, very simple. So I'm saying, is hospitals, is insurance, which people talk about in US, I'm saying, are they, or health insurance is where I was referring. Where is that, where will society adopt that technology or that product over, will there be mass adoption? If that is what you can get right, investing is not, and just have to stay, invested then. I think that's the thing. So, we kind of, we move ahead. Yeah. Now, again, as I think Abhishek spoke about it, that it is the earnings, it is the price to earnings, EPS and price to earnings, which kind of gives the valuation of the stock. I just want to tell you in very simple terms for people who are new and basically to understand the concept. See, it's like if as an equity, you are an owner of the company, right? Now, let's say, I'm just taking an hypothetical example. If somebody happens to own me, I'm just saying, what does it mean? It means all my earnings and all my future earnings is of that person. So if I earn, let's say, 20,000 rupees and I'm doing very basic here, and I invest and I will kind of earn for 10 years, then my valuation is 2 lakh rupees. And that is, my value. So I'm saying it is my earnings and the number of years that I'm going to work is my value. Now you will discount it to current valuation, you will do discounting models, and then, you will increase my earnings. Those are different. I'm saying, but a very, very simple term for valuation is the earning that I will have today, and then, the number of years I can have. So let's just move ahead. Now, just think about it. If my, sorry, yeah, we just stay here. If my earning increase, from 20,000 rupees to 30,000 rupees, my valuation also, moves actually from 33 lakh rupees. Goes up, my salary goes up. I get a better education. My value goes up, from 40,000 rupees. Even if it's my, my number of years is just 10 years, it'll be 4 lakh rupees. Now, what Abhishek was referring, where the growth is exponential, is wherein the both, the earnings and the valuation. And valuation is, the price to earning ratio, it expands. Just take an example of India, let's say. If I want to invest, that means, there is more, the PE expands and the earnings expand is where you get exponential growth. And, if you look at here, if my earnings increase from 20,000 to 40,000, my PE increases from 10 to 15, my valuation actually moves up from 46 lakh rupees from 2 lakh rupees. So I'm just I think as basic investors, all that you have to think about is will the earnings of the stock go up over the next 5 years, 10 years, 15 years? I think if that is what you can, again, we spoke about it, it's very common sense things that will take that. If that is what you can get right, over the long term, investing in stock market has created wealth for retail investors, as we kind of see. Gaurav? Okay, yeah, we spoke about it. Now, just to prove this hypothesis, we just take a few minutes more. And to prove this hypothesis, we did a study. We did a study of retail investors at ICICI Direct who invested in stock markets. And what has been their returns? So this is not about FIs, this is not about hedge funds, these are about simple retail investors who invested. What did they experience? What did they go through? And what was the return? So, Gaurav, And again, this is something which is, I'll tell you, is a very classic phenomenon which happens, and I'm sure many of you would relate to that. One, when we invest in a particular stock, obviously we're bullish, right? I mean, that's why we're investing. So, we feel that the stock will go up. I mean, there is no doubt in our minds that the stock will go up, and hence, we've invested. If the stock falls, it's okay, no stress. We are, we're happy that, we have actually got some more opportunity to add the stock, if the price is falling. If the stock falls further, what happens generally is investors are, apprehensive, they're thinking, but, they hold on. They say, fine, the stock will move up. Imagine, we have all witnessed periods where 2-3 years, they have invested, the stock goes down. Investors get impatient. What is happening? I made a wrong bet. Did I make a right bet, wrong bet? And if it continues for 4-5 years, 5 years, the frustration is so much that investors just think that, the day I get my price, I'll exit that stock. That's just how typically investors think. And now you'll hear these terms called 200-day moving average, 500, lifetime high. I'll tell you, it kind of relates with everything that as human behaviors we think. That, I'll tell you a very classic case of Tata Motors. Tata Motors was a stock, some 5 to 7 years back. I'm sure many of you tracked it. Trading at 650 rupees. It did a preference at 550. Obviously preference investors invested. The stock from 550 went to 350. From 350 went to 250, 100, 70. Now just think about it. Investors bought Tata Motors at 650. What is going in the mind? That, and he's seeing the price come to 350, 150, 70. He thinks that, boss, what a mistake that I make. The day I'm going to get my price, I'm going to exit the stock. Now, just think about it, what happens. Tata Motors started moving up from 150, 200, 250, 300. What is happening? People are, whoever was there, are exiting, right? They're moving out of the stock. But the stock keeps on moving up, right? And you hear this concept of lifetime high, which means what? That all the old, there were people who sold, the existing investors or the old investors sold, and the stock is still moving. That means there are more buyers on the stock. So you will hear that, all the old guys are, moved out of the stock. And then there's a rush, actually when the stock breaks its 52-week high, lifetime high, actually the stock moves up significantly. So, it's actually a phenomenon. It's all these are human behaviors. 200-day, people talk about these moving averages, right? You've heard these terms very, very frequently in stock markets. It's all based on emotion. 2 saal, 5 saal stock agar ke baad agar chal raha hai, so that means there is a strength. That means, fir bhi price agar upar ja raha hai, that means there are more buyers. So I think, just understanding this segment, this phenomenon is important when we're actually investing. But let's just see some results of what investors have done. Abhishek, you want to add something? You can always be free to, come in, share some thoughts.
No, sir, I think let's just continue.
Yeah. Now, this is what our investors, retail investors at ICICI Direct had. And you see the trend, they bought a stock moved down, and this is average of their holdings. So it's not about single stocks. But if for investors who held the stock for more than 12 months, they have, at a cohort level, we have seen them making money. So the learning that we're talking about is, give your time to investments. Have a longer time frame. Don't believe that the stock will move up just in 3 to 6 months. That's one of the common mistakes in investing, which leads to frustration. And also, if you have to have a cash flow view. That if you would need a cash flow immediately, or would you not need the cash flow immediately, and invest to that amount where you don't have a cash flow dependency, because then you will have this need to sell a stock, which if the markets don't move, the stock doesn't move, you actually kind of don't have a good experience. So just invest for long term, for a longer period of time, and we have seen our investors actually making money in stock markets. Just move ahead. We actually further split this into good company and Nifty 500, outside Nifty 500, which means you don't know what kind of stock, individual stock that company was. we've actually seen, you look at the trend here, investors who stayed with good companies, and good companies, I'm meaning the Nifty 100 companies here, they've actually made better returns. Because then there is a single stock risk. कुछ stock में मतलब whether the promoter did not do well or the company did not do well. But I mean, if you stick with good quality stocks, and again, this is the audience that we're talking, our audience which are new to stock markets, they're not very well on the nuance on companies and investments. Just stick to good companies, and we have seen investors have done that. Retail investors who have done that have actually made money over the long term. Gaurav? Yeah. Another, in fact, approach which investors have is they like to have concentrated portfolios. They think that कि ये stock में मैं 5 लाख 10 लाख डाल दूंगा और ये double हो जाएगा, triple हो जाएगा, तो मेरा valuation हो जाएगा. And we've heard about names like JP Associates. I mean, you think कि मतलब ये मेरे को double करके दे देगा, मेरा valuation करेगा. Let's look at the results where people have thought कि concentration and without concentration. This is about concentration of portfolios. You look at here, 1 to 3 stocks in the investor's portfolio, 4 to 6 stocks, 7 to 10 stocks, and 10 stocks and above. And we also further categorize into large cap, mid cap, small cap. If you look at the quadrant, the best returns have been made by investors who have good companies, but they have had asset allocation, which means they have had 10 to 12 stocks. So that means they diversified their portfolios. These are very, very important. And if you look at it, even within concentrated portfolios, it was a large cap actually we did well. See, I mean, in small caps, you can actually, there is a tendency, really depends upon that individual management to do well. But large cap, even if you have a concentrated portfolio, the returns were better. But the best returns were when you diversified your portfolio. So if you want to construct portfolios, good companies, diversification, 10 to 12 stocks, having an asset allocation in check, I mean, these are 2 learnings and 2 things that we have seen investors, benefiting, making money from. Gaurav? Yeah, this is again very important. What price do you average? And obviously the quantity of averaging that you do, which means that, let's say, I want to buy HDFC Bank, let's say, just take an example, the stock was trading 1650 rupees. Obviously it's, it's a value stock. It's the largest, in the banking sector. Everything is good about the company over the long term. But I want to buy 1650, I invest, let's say, a lakh rupees. The stock falls to 1625. I think it's good. I invest another 50,000 rupees. The stock falls to 1600 rupees. I invest another 50,000 rupees. Now, what's happening is that my surplus is, the cash surplus that I had is out. So I'm completely, I'm fully invested. Now the stock had gone to 1525, 1500, 1550. I am not sitting on cash. So, so I'm not, kind of, when the time was to buy more, I did not have cash invested. So again, we analyzed our investors who rushed into investing, or they systematically at every dip invest in the stock. So people will be categorized: 1 to 2% fall in the stock, 3 to 5% fall in the stock, 5 to 10%, 15 20%. You look at here, investors who actually averaged at a particular interval, didn't rush in. You look at the returns that they made. Actually you see here the chart shows you 10-15%, or every 10% fall you invest 100%, again in the stock, and you see they made money. And I mean, there were investors who actually increased their quantity while the stock fell. So the stock fell 15%. If they invested, let's say 20,000 rupees, the next investment is 40,000 rupees. Actually, so I'm just saying so not rushing in, and it's also important not to rush in because of various reasons. The company the stock may just fall 5% for a reason, and it may take some time for the stock to recover. So not rushing in, having an averaging strategy, that's very, very important for investors, and people who are new to markets, can simply adopt SIPs, as averaging strategies, which will keep on accumulating. So I'm saying, if you are getting in stock market, getting these things, having a little more systematic approach to investing is something which is important, helps, and that's what we wanted to kind of showcase to you. Yeah, I mean, this is just to share investors' return in good companies, large cap companies versus small cap companies. I mean, it's not to deter against investing in small cap companies. They, on an individual basis, have created a lot of returns. But it is upon the investor's ability that are you in a position to well research that stock, then you must. But if you are not, then it is better to stick with large cap companies for new investors, for novice investors. You may not have the wherewithal to know what's happening in that stock sector. So, if you're new and investors have done that, this is what our returns has been. So we wanted to showcase you some of the facets of investing, some of the tenets of investing, wherein a systematic approach helps. One thing is clear. I mean, in India, you look at 20 years, you look at 40 years, investing in stock market has created wealth, right? But it is the systematic approach which kind of adds more, to your investments and also keeps your anxiety levels low. So I think that's what we wanted to kind of share today, on this presentation.
Thank you so much, Saurabh. Thank you so much, Abhishek, for this wonderful session. One thing, if I can ask you for people who want to stay invested is horizon. What should be a bare minimum horizon one should look at least?
Abhishek, you want to go first?
Abhishek, okay.
There is no look. I'm an MBA, and the answer for this, Gaurav, actually is it depends. See, like there is no answer for what is the minimum horizon that you want to stay invested in. But I would say unless if you want to enjoy your life and like let your money work for you, then you should actually be invested for the long run. Because if you're actually like investing thinking with the mind, I'll just come and make money in a month and then get out, then आपका वो एक महीना पीसफुल नहीं रहेगा. आप हर दिन पूरे टाइम शेयर प्राइस ही देखते रहोगे.
Right.
And that is not the fun of investing. So you should know who you are. Do you enjoy that? Then you as well as you can trade. But I would say the ideal time for a look, if you are getting money in 1 month, then it can either be luck or you being a good technical trader. It cannot be your investment thesis playing out in 1 month. A thesis cannot play out in 1 month. It takes few quarters at least, if not few years, right? So by that logic, I would say don't think of anything less than 1 year. When you say how long, if you have a logical way of investing in the company, if you have a logical premise, minimum 1 year. But ideally, as long as the management is delivering, you should stay invested.
Absolutely.
That is how you there's so many stocks. Even I can tell from my own experience, I can say this. हर किसी के पोर्टफोलियो में ऐसे स्टॉक्स होंगे जो मल्टीबैगर बने होंगे, बट क्या आपने मल्टीबैगर रिटर्न कैप्चर किए? दैट इज द आंसर. एवरीवन कैन से अरे ये बजाज फाइनेंस तो मेरे पास भी था 6 साल पहले, आपने होल्ड नहीं किया ना. आप होल्ड करते आपका भी 100x बनता. सो आंसर इज if you don't have any emergency need of that money, and if the management is delivering, stay invested for as long as the story is intact.
Absolutely. And one more thing I would just add here is like with ICICI Direct, there's one good feature that if you want your money on the spot, you can sell the share on that day, and within 5 minutes you get your money back in your account from our e-ATM facility. So in terms of need, also one can actually look at ICICI Direct and can be invested through us. That's one of the that's my 2 cents to people. So thank you, Saurabh. Thank you, Abhishek, for this session. Thank you, viewers who have viewed this. And it was a great session. So hoping for much more session with you two in coming days. Thank you so much.
Thank you.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.